All right. Well, let me kick this off by saying good morning and welcome to the second hour of TheoTrade. I am Professor Jeffrey Bierman. I'm broadcasting you live from Chicago. And today is Wednesday. Yes, it's hump day. Wednesday, September 10th, 2025. Good morning, TheoTrade members. So at the risk of losing time, because Don ate up 5 valuable minutes, let me just say hello to all of you. I see you out there. Michael Trains, Hash 5 Ship, Tim, Peter Schrager, Guatemala. I got to move forward with this. I'm not to diss you, but there's too much to cover and not enough time in my life to get this done. All right. So let me give my 2 cents. I don't want to copycat Garrett, no value added. I do not want to copycat Don Kaufman, no value added. I want to tell you the way I perceive markets. I want to explain why my clients or the Genesis Cog members are doing really well on the short side, okay? The theme of the day says it all, okay? Today's theme is called Fooled by Randomness. Once upon a time, 25, 30 years ago, markets were random. You'd wake up any given day and the markets were equally up to being down. It was 50-50, 54-46, 52-48. It added up to 100%. Markets would literally, you could flip a coin. Okay, those days are over. The market's rigged. There is no randomness anymore. So let me explain where this term comes from, because I didn't coin it. I didn't. But it comes from Nassim Taleb. So Nassim Taleb wrote a book where he sold millions of copies. And the book is called Fooled by Randomness, The Hidden Role of Chance in Life and in the Markets. The book is written by Nassim, N-A-S-S-I-M, last name Taleb, T-A-L-E-B. He's a professor of finance at NYU Stern School of Business in New York University. And it deals with the fallibility of human knowledge. The book was first published in 2001, okay? And updated editions were released a few years later. The book is the first part of Taleb's multi-volume philosophical essay on uncertainty titled Incerto, which is Latin for uncertainty, which includes The Black Swan, The Bed of what's called Proscrates, Anti-Fragile, and Skin in the Game. He's a very prolific writer. I don't worship the guy, but I do track him. I do follow him. I'm trying to understand what he sees as a professor. I look up to certain people. I look down on others. Him I look up to. He's a quant geek. So let me give you his thesis. His thesis sets forth the idea that modern humans are unaware of the existence of randomness, okay? And they tend to explain random outcomes as non-random. There's nothing random about the market. It's rigged by machines, okay? Period. Human beings overestimate causality. For example, they see elephants in the clouds instead of understanding they're in fact randomly shaped clouds that appear to our eyes as elephants or something else. Or they tend to view the world as more explainable than it really is. So they look for explanations even when there are none. Again, that's CNBC and Bloomberg. They look for explanations why the market's up, and there really is none other than momentum. This is just a momentum-driven market, okay? And there are other misperceptions in randomness. But the idea is this. Markets nowadays are not random patterns. They are predictable, curated, manipulated, manicured patterns done by algorithms. There might be slippage any given day here or there, but in reality, the markets are purely engineered and rigged to go up at certain times. So when you come at me and talk fundamentals, I can't listen to you anymore. Please stop, okay? The markets are overheated and they're still going higher. The market, they come out with data today, and again, I'll bring out the catalyst to explain this, okay? If a tree falls in a forest and there's no one there to hear it, does it really make a sound? And the answer is maybe yes, maybe no. But this market's not listening anymore. It doesn't care about data. The data is irrelevant. The market suffers from confirmation bias. What's confirmation bias? Confirmation bias is when you have already made up your mind what you want that outcome to be. You've already made up your mind. So whether the facts say, whether the facts validate the outcome or the facts refute or repudiate the outcome is irrelevant to you. You are still going to go forward with your plan and move the market up and buy it because you just don't care. You know, it's the expression, the trend is your friend, so why fight it, okay? It's not psychology. Psychology is you. The markets are moved 90% each day by machines. And the machines are looking for slopes. They're looking for momentum. They're looking to curate, cut down the slippage, kill the variance, kill the volatility, and get this thing moving. Because if they can kill vol, It makes their trading easier, more profitable, less likely, less risk, less volatility. That's what happens. So the momentum train was already ramped up last night. Oracle comes out with earnings, and we'll get to that. But stock traders were already ramping up on bullish positions on the back of an expected dovish CPI. So the numbers come out today, and the numbers are not hot. They're not dovish, but they're good enough for the market to live that confirmation bias and move forward and get even more bullish for tomorrow. So if you're coming out today and shorting the market, you don't understand that. You clearly don't understand the business at all. And I can fix you. I can actually fix you if you join the Genesis Cog. You cannot fight these algorithms. It just simply doesn't work. Institutions are not going to sell here. They're just not. Why not? They're not going to sell because it's the end of the quarter. We got 20 days. The market's ramping up. You got Oracle coming out today. You got the AI narrative. It's just going to keep going. Okay. When things are vertical, machines buy. When things are waterfall, machines sell. It's really easy. So the idea that you're going to tell me the market's random, please stop. You're insulting me and you're insulting the TheoTrade. We don't need to be insulted. It's not random. It moves each day. It'll move. But the movements intraday are not random. They're already predetermined to go up or down and move around, and we'll see how it plays out. So the stock traders were already ramping. Even before the move, the market was already up 22. Then you get the dovish CPI. Now it's up, what, 39? It was already going up. So this is just confirmation bias. The data could have been terrible, and the market would have gone, okay, we'll rationalize the reason, and we'll still buy. The market already made up its mind. It wants to go higher. That's it. So if you came in short, you screwed yourself. You shouldn't have done that. You can't fight markets that are going up. Gianni says it, Corey says it. It's a fact. And then you come out and you get this. Lies, damn lies, and you know where I'm going with this. Lies, damn lies, and statistics. Where am I going with this? Look, the Biden administration, in all their infinite or lack thereof wisdom, okay, screwed up all the numbers. They made up fake numbers. So the Republicans went in, they unwound all the data, and they found out that the U.S. economy generated 911,000 fewer jobs than previously reported. And then it adds insult to injury, I call fuzzy math, that there's now downward revisions being made by the current Fed. The current Fed now is making downward revisions, okay, in the latest jobs report to tell us that the 911,000 is actually conservative. Conservative. They're actually estimating it at 1.2 million. And this morning, there's a headline on Bloomberg that's saying 1.2 million is actually even more conservative. It's actually closer to 2 million. So is it 900,000? Is it 1.2 million? Is it 2 million? Ugh. I don't care. It's just lies. The data is just corrupted. It's a bunch of hooey. All the data's worthless. It's done by a government BLS, which should be BS, remove the L, Bureau of Labor Statistics. And they're just massaging numbers so they can make the Fed happy and make Wall Street happy. That's what they do. So whether the data is to be trusted, it's not to be trusted. It's not to be trusted. Even when the market's down 2,000, if the market sold off 2,000 points today, I still wouldn't trust the data. Okay? It's not about being bullish or bearish. It's just the data itself is people taking the data and they're reading into it and walking into existence what they want. They want the market higher. They got it higher. There's no randomness here, people. There's none. It's just we're going higher. Now, let me show you exactly what it looks from my perspective. So if you're shorting this market, I pity you. I actually pity you, okay? I work off of 3 time frames. It's the Alexander Elder Scrum. I look at things on a weekly basis, a daily basis, and an hourly basis. I've been doing this for 37 years. It works phenomenally. Everybody makes mistakes, but my timing is usually pretty good. I don't know where the top is. So don't waste your time sending me an email. I don't know. I don't care. I don't pick tops by numbers. That's a fool's errand. All I can tell you is my model basically is never wrong telling me what direction the probabilities are giving it. And what the probabilities are saying right now, if I could just pull this out, is simply this, okay? The MACD is never wrong. You are. What is the MACD doing? Just look at the slope. Forget everything you've ever learned, ever in your lifetime. Look at the slope. What is the slope doing? It's pivoting higher, higher. It's getting higher and more overbought and more overbought. Translation. This is what it means to an algorithm. Not you or me or Don. It means to an algorithm, buy more. The algo is programmed to buy strength. That's what it's programmed to do. It doesn't sell strength. The algos are black and white. They're binary. It's not buy and sell. It's buy or sell, okay? So they're buying today. How much? I don't know. I don't care. If it's on the way up, I'm not going to waste my energy to short this, okay? I said this 3 weeks ago. Don't short the market. I said it yesterday. Don't short the market. I've been right every day. I keep telling you. I'm not that smart. I'm just following what the algo machines are telling me to do. They're telling me the risk reward is heavily to the downside. But for the moment, in the moment, right now, okay, we're going higher. I don't even care about the advanced decline. That advanced decline could be 15 to 8 the other way, and it's still going up. It doesn't matter because tech and financials are on the way up. That's all that matters because they carry 70% of the index. So if you want to short this, good luck, Charlie. If you work for me, I just fire you. You're fired. I don't care what you think. I'm not shorting that. I don't care. There's no amount of money I'm going to short that. And you're like, but when will you? I will short it when it turns down. I will short it when it peaks and rolls, when the algorithms actually are not biased to one side. They're all skewed to buy. That's why it's up 40, people. Forget your fundamentals. It doesn't matter. The market already made up its mind. The institutional managers are buying for window dressing. Now you add to the mix machines, and what do you get? It's like rock'em sock'em robots. You have a double tailwind to move this. So I don't waste my time, but I won't buy it either. Why? Because I'm a risk reward guy. I'm a risk reward. There could be one fundamental piece of news could come out and blow this out, but I ain't waiting for it. You can wait for it. So to me, it's a pure waste of time to short this market. If you're going to short the market, tell me this. My goal is for it to go down in 3 months. Then short it. If your time frame is tomorrow, you're just busted. You can forget it. If your time frame is next week, forget it. If you're going to get short, close your eyes, bite your lip, and walk away from that screen because it's just going to create angst and anxiety every day. Either wait until it rolls over and drive with the machines or sit there and absorb pain every single day, okay? I can give you an easy answer. This is what we're short. Okay, I'm short Unilever. Why? Because it's curled over. I have a bearish divergence and it's curled over. Why do you think I'm making money? Tell me, everybody. Why? Because the machines are driving it lower. That's why it's not going up. I don't short on the way up. You might. I don't. I'm not going to fight the machines. I've been doing this long enough to lose enough money to go, you know what? Can't fight the machines. So to me, this is just fooled by randomness. The market wants to go higher. It just does. It just does. And I'm not even looking for a reason for it. I don't need a reason. I know it's a bubble. It's just going to keep going because greed trumps risk. That's a parabolic MACD 4-hour. Forget it. Not interested. I wouldn't even short it here. I wouldn't even short it at 50. I'm not shorting what's up, okay? Because it doesn't work. And if you shorted Oracle, which is my opening stock, how's that working out for you? You're trying to short a parabolic MACD? Holy cow, if you work for me, you're fired. I take away your security. You can't short this. You can short it in 3 months. Who's going to sell this at the end of a quarter? Who? Every manager who doesn't own this has got to chase this. So to chase this, they might sell Apple because it's been kind of wishy-washy. They might sell Amazon, but they're not going to sell this. This is a home run grand slam trade. So I called it on my list today, and it's the expression. The expression is simple. It's cloud nine. They're on cloud nine. The joke, they're keying off the word cloud. This is a cloud trade. It's in the clouds. They're making money off the cloud. They miss their numbers, but in this business, it doesn't matter what you reported. All that matters is what going forward. Going forward matters than what's happening behind you. What's happening behind you, that's passé. Nobody cares. What are you going to do for me next time? They put up numbers of 30 to 36% on cloud business. That's why it's up $90. Could it be up 150? I don't know. I don't care. I'm not going to short it. How am I going to make money shorting that stock? How? It's like everybody in the world wants to own this at this point. It might move around $10 or $20, but I don't want to deal with that volatility. It's just too strong, and everybody wants to own it. So Oracle, to me, is the stock. If people say, why is the market up today? It's not the data, it's Oracle. Oracle gave you green light to go out and say, that's it, I'm buying Advanced Micro. So now everybody's like, well, let's go buy back in and buy Advanced Micro, even though we sold it the other day. Because why? It's AI. AI is running the market. The whole market's hooked on the AI narrative. So until the AI narrative dies, not much is going to happen. So they probably piled into Palantir. That's probably up, of course. What else is up? They probably have NVIDIA up. Of course, it's the AI narrative. It drives the market. So to me, if you're trying to short technology, I wouldn't do it. I would avoid it at all costs. You're better to own it and trade with Gianni than to short it. The other stock of the day, and I want to show you that if you're telling me, you're going to tell me, I can buy anything. Oh my God, you can't buy anything. Let's go to Synopsys, okay? I've been around the business a long time, okay? I have lost a lot of hair. I have had, Gaviscon. I've gone through doctors. I've been through all of that stress. I know what it's like, okay? It feels like a rush on the way up. You think you're so damn smart, okay? For those managers who own Synopsys, okay, they're like rocking underneath a desk right now on Xanax. Take a look at what happens when you're wrong. This business is so ridiculously irrational and unforgiving in both directions. I don't own Synopsys. I know what they do. They are a design app platform. I know what they do, so you don't need to explain it to me. I've been tracking it forever. It's a very strange stock when it comes down to liquidity. Okay, look at the liquidity on Synopsys. Okay, 185 million shares. Not something I want to deal with. Not something I really, really want to deal with. Not me personally. But for those of you who tell me, Bierman's a moron. He never trades tech. I own tech. I just don't own things like this. This is the business like the ABC, the thrill of victory and the agony of defeat. This is what happens to managers this is a career-ending trade for a number of managers. Their career is over today because they're levered on this. Their hedge fund guys are probably on 15 to 18, 20% of this, and they just blew their clients out of this trade. This is not a misprint. Take a look at this trade. I'll bring it up on a daily chart. People are like, that's a misprint. It's not a misprint. That stock is down 200 points today. It's going to bounce. Really? Who's going to buy that and put that on their blotter and show it at the end of the quarter? They'll be fired. Look at that stock. This is why, okay, I keep telling you, never get ahead of earnings ever. Did you get ahead of earnings on Oracle? You got lucky, because this is the sobering reminder of what happens when you don't get lucky. So for every manager who said, I own Oracle, I'm up 90, they probably have the same weighting in Synopsys, and the Synopsys eviscerated and neutralized their entire gain on Oracle and then some. Look at it. That is not a misprint. That sucker's down $203. Okay, why? Don't care. They're down. They beat the number. They didn't like the guidance. They just happen to like Oracle's guidance. So I'm just warning all of you, like, you're in a market that's at an all-time high. Okay, it's all about you're being fooled by randomness. The market itself gives you this idea. It sends a message like, I can just buy anything. I can buy any tech. It's got what does it have? AI? I'll just buy it. Get me an AI. Okay, they're part of AI, and look what happened. I'm just telling you, there comes a day in this business, because I've been there. I know what it's like for a lot of you. I've been there with that 40% down day. Been there, lost hundreds of thousands in a day. Been there. I know what it's like. It's like you just want to jump out of a building. You want to drown yourself in a river. Don't. I'm just reminding you, whenever you're at a high, just hedge it. Just hedge it. All you had to do was hedge this trade. Just buy a put. That wouldn't have solved the problem, but it would have hedged you off probably 3/4 of the damage on this. Whenever there's earnings, I always exit the trade or I hedge it. That's a lesson for all of you. Oh, I own Oracle. Good for you. How about those who own Synopsys? They're literally on the verge of insanity today. I bet they're just sitting there, just rocking underneath that desk. That's a nasty trade. That's not a misprint. Shock treatment. So for a number of days, you saw United Healthcare. Oh, I own United Healthcare. Warren Buffett's buying. I'm just going to keep buying. Okay. So you figured to yourself, well, if United Healthcare is going up, that just opens the door for me to step in and I'm going to load the boat on Humana. How'd that work out for you, genius? How's that working out for you? Okay, Humana right now is losing government sponsorship in terms of what the government helps them do to subsidize, okay, their payouts. The Trump administration is cutting back on Humana. Here's a stock at $309. Everybody's like, oh, this is so easy. All I got to do is just keep buying and follow the narrative. Sure, there's no randomness here. It's walked up every day for 30 days. What the hell? It'll be up 31 days in a row. Really? Because when you flip a coin, okay, you're thinking to yourself, I'm going to flip a coin and get tails 90 days in a row. Isn't that what you think? You think it's 50-50. Does that look 50-50 to you? Don't be fooled by randomness. That's manipulation after Buffett bought. So everybody thinks it's green light to buy. What I keep reminding everyone of is the business is really simple. Whenever it's at a high, just sell it. That's my goal in life. When I get to a high in the year, I just want out. I'm not looking for a reason to sell. Why? Because by the time I find the reason, the stock will implode. The stock's already imploded. It's already down 50 bucks. If you worked for me and didn't sell that stock at that high or didn't hedge it, you can consider yourself fired. You cannot give away gains like this. Oracle. Do you own Oracle, a lot of you? I know you do. You know what you should do? Yeah, buy puts on it today. Protect your gain. Don't give them away. There's no excuse for this. Nothing goes up forever in this business. Fundamentals eviscerate technicals. Technicals mean nothing. Fundamentals rule the roost, okay? Don't be fooled and thinking that technicals are the answer. The markets move things up in a non-random phase, but all it takes is one piece of news to change that randomness. So on any given day with no news, the market's not random. But once news comes out, you can break the randomness, which tells you that fundamentals are way more important than what? Technicals. But right now, the market doesn't care about any data whatsoever. It just wants to buy and run higher. The last piece of news today is this, okay? And I'm not short this. I was, and I killed it. The Genesis Cog members, we killed it on this trade. Most of them got out between 37 and 36. Some actually got out at 32 on the short from 47, okay? Again, I keep reminding you, around earnings, I'm going to say this every time I come on. I'm going to be a broken record like Garrett. When earnings come out, just get out or just hedge it. Just buy the put. If you work for me and you held Chewy, literally, you're fired. I don't even care what your excuse is. I want to prove to you that the market knows absolutely nothing most days. Most days, the market's as dumb as a bag of rocks. Here's Chewy. Now, get this about Chewy. The stock had run from 34 to 44. It got 5 upgrades. All in. We love Chewy. Love Chewy. Okay, look what Chewy reported today. I want you to see this. They reported a 20-cent beat, and the stock got destroyed. Destroyed. Okay, what lessons can I disseminate to you? Can I impart some wisdom to you? First things first, around earnings, all you had to do is buy a put. That's it. Buy a put and you could save your ass. Second is, you could have walked in and just sold the whole position ahead of earnings. Even better. That's what I would have done. Third thing to remind you, this is a sobering reminder, okay? When you tell me that fundamentals don't matter, you're right. They do not matter in the short term. They don't. They don't even matter most days. But I keep telling you, a lot of you are not understanding. We're going to go down a lot. We're going to correct nastily because we're so wildly overpriced now. And I keep telling you, the earnings don't matter. They matter in relation to expectations and valuation. Take a look at Chewy. It trades at a 33 multiple. Chewy's never going to grow at 33%. Its earnings for the quarter were good. They were up like 15%. But I keep telling you, on the way down, fundamentals matter. On the way up, they don't matter. They don't. When markets start collapsing, the first thing I get calls from traders and hedge fund guys. They call me, Bierman, what's it worth? They never ask that on the way up. Never. I got to get in. On the way down, they're like, I'm getting my butt blown out. What do I do? What's it worth? You should have asked what it was worth on the way up, not just on the way down. The reason why the stock is getting blown out has nothing to do with guidance. It has nothing to do with the earnings because they blew it away. They killed the stock simply because The market knows that the consumer is pulling in and the stock is expensive. The markets are as dumb as a bag of rocks some days. The market got that right. It got it right because the stock is just simply overpriced. That's it. It's overpriced. It's not that things are bad at Chewy. They're fine. Make sure when you're trading any stock, even Oracle, if you can't price it, don't trade it. I'm telling you, it's going to cost a lot of you your accounts. I'm telling you this. If you can't price it, don't trade it. Got to know what it's valued at, or don't go near it. Basically, Chewy got chewed up. My title of this, I called it, people, Unleashed. Get the pun? Like a dog leash? Enough said. All right. Now we're going to roll back to the last part of my discussion here today. I'm having a lousy day today. We're having a really lousy day. My shorts, they're doing great. My longs, they suck. That happens, man. That happens because they're selling the weak and they're buying the strong. I'm used to this. Doesn't affect me. Okay. And when the market rolls around, they'll just roll back into my longs and run them up. That's what usually happens. But the shorts are really doing good. All right. So let's go back in and talk about, and I'm going to bring up McDonald's here. We're going to talk in the final installment of asset utilization. Asset utilization, okay? We're going to talk about financial radioactivity. Radioactivity means like it's a radio and it's broadcasting activity that's being done inside the company. People, you have to start to understand like the way my mind works. It's like a labyrinthian maze. I'm just trying to put it together like a jigsaw puzzle. I'm just trying to get you to clue like certain words because I was English literature major in poetry and Shakespeare expertise. I use words to colorize so you get some type of like, stimulation here, just apart from staring at numbers. Financial radioactivity means that the asset utilization metrics, okay, they broadcast. They tell you ahead of time if you can track the trend, whether the company's in a good place or whether the company's at risk. That's all it does. I spent, a couple of weeks ago when I started, before I, switched gears and did Risk Impact Week, I talked about total asset turnover, asset utilization, operational efficiency. It's all on the left-hand side of the balance sheet. Property, plant, equipment, net working capital, cash, securities, inventory, blah, 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 okay? I went through the 4 bullet points. Today is the final scenario. I'm going to take you through the inventory turnover ratio. This is one of the most underrated metrics I have ever seen, and it's going to freak a lot of you out how it kind of works, especially as it relates to these different sectors. So I'm going to go through a number of examples and just kind of cut it short, because I think by now you understand after 4 days kind of where I'm going with this, but you need to still see at some point the value and how the actual formula sets itself up. So the inventory turnover ratio is a lot like the other ratios. On the top side, you have to have something. So on the assets, it's sales. For inventory, instead of the top side of the ratio of sales or revenues, it's cost of goods sold. Cost of goods sold. And again, where do you find this? You can go into the company like I did yesterday. I walked into CrowdStrike. I opened up the investor relations. I opened up financials. I said it'll populate, it'll show. I promise you it will. It's a law. They have to show their 10K, the yearly, 10Q, the quarterly. It's easy to procure and it's free. Free. I don't want to do it. It's because you're lazy. Just do it. Look at it. You're like, oh my God, this is so easy. Of course it's easy. You can look at it. Some companies will publish the actual ratios for you without you having to go in and number crunch them. Others won't. It varies. But the Thinkorswim platform only provides 2 asset utilization ratios. Why? It has to do with their budget. It has to do with the vendor. And more or less it has to do with, well, what are the 2 most important ones? Turns out the 2 most important ones are asset turnover and inventory turnover. But if you were to ask me, does the inventory affect Tesla? No. Does the inventory turnover ratio affect Caterpillar? No, has 0 impact. Why? Because it depends upon what the company does. For companies that are heavy-duty cyclical companies, okay, what matters most is the asset turnover or the operating leverage, the long term, right? Total asset turnover. But when it comes to companies that are service-based companies, companies that make food, companies that disseminate food, companies that serve food, companies that that offer a service, Starbucks, McDonald's, Burger King, okay? Those companies are not measured by total asset turnover. It's a useless indicator. for a company like Tesla, for a company like Dell, for a company like a home builder company, it's very useful because they're assets that you drop on your foot, they're hard and they hurt. They make a big difference. When it comes to what's called return on equity companies, companies that are mainly service-based, that don't rely heavily on long-term assets, but short-term current assets like inventory, accounts receivable, and cash, this is a make or break indicator. If you know this indicator, you can make millions of dollars. I ran a hedge fund. I went through it. I used to go through inventory turnover. I could literally pick off companies to short and long faster in a blink just by looking at the number. I could look at the change in number going, that company, something's wrong. That company, something's right. So this is how you crunch it. It's the cost of goods sold, okay, and that's provided in the company's income statement, divided by average inventory, and that's found in the company's balance sheet. They take the inventory at the beginning of the year, take the inventory at the end of the year, they add them together and divide by 2. It's that simple. It's called inventory turnover ratio, and what they eventually do is they convert that inventory turnover ratio into a 365-day-a-year metric. So for instance, you walk in here and you look at McDonald's and you're thinking, I don't see much out of McDonald's at all. Okay, and I'm going to fix this right expansion setting to 10. You're like, I don't see much of McDonald's at all. I don't understand what you're talking about. Bear with me as I walk you through the example, and I'll walk you through retail. Here's McDonald's. You go down to McDonald's in the Analyze tab, and you look at the inventory turnover ratio. Now, this one I think is provided quarterly, so you got to switch to annual to get this. It'll be provided annually. You walk over here, and you look at the inventory turnover ratio, and you see 221.94. What does that usually mean? What they've done is they've taken the number and they've converted into a 365-day-year business, which means this. Round the number up to 222. Bear with me here, TheoTrade members. This is not rocket science. It's really easy. Even my students, because I went through this last week at Loyola for 21-year-olds, and they're like, there was like an aha moment. 222 means there's 365 days a year, right? So McDonald's will turn over its inventory 222 times a year. Stop and think what that means. Take 222 on the top side, divide it over 365. That means every 3 days, some truck in a McDonald's across the United States pulls up and drops off burgers, fries, and all supplies at that McDonald's. That means every 3 days, 2 out of every 3 days, a McDonald's truck will show up at a McDonald's and unload all of its inventory. They will go through their inventory every 3 days. Every 3 days, McDonald's runs out of food, burgers, fries, shakes, nothing. They have no food in the place. They can't serve you food. So every 3 days, they go through their inventory. It's just mind-blowing to think this. You're thinking like, oh, they buy enough for a month. They don't. They buy enough for 3 days. See that? Okay, now watch this. I'm going to go over to something like Starbucks. Now, Starbucks is a little more, drink than food, but I want to bring it to your attention. Go to Starbucks and look for Starbucks. Starbucks turns over its inventory every 13.6 days. You see that? That simply means, okay, and you run this into a 365 number. That means about once every 2 weeks or thereof, a truck shows up at Starbucks and drops off all of Starbucks coffee beans, all of its food supplies, the napkins, everything that it needs to serve Starbucks products. That's what it does. Look at the difference. I want you to see the difference. McDonald's is 222, Starbucks is 13. Why? Because food has a high spoilage rate. Coffee doesn't. Coffee has a shelf life. Food doesn't. In McDonald's, the food's already frozen in the truck. It gets there. When they unfreeze the food, they got to serve it right away or it spoils. This is how the business works with service businesses. If you learn this, you can become a millionaire, literally. You can sit here and go, my God, they've improved their inventory turnover 11%. That's the new guy who came in. It's like, we're not moving product enough off the shelves. It's good. Inventory turnover means whatever's on the shelf, okay, is getting out to the consumer. When the inventory builds and the inventory turnover number goes down, that's a red flag. If I see an inventory turnover consistently go down quarter over quarter, I'm going to short the hell out of that stock. It's telling me they're not moving product. They're going to miss their earnings. It's a clue, like Blue's Clues. The numbers themselves will tend to be static. So it might go up like, it goes to 14 and it drops to 11. That's not a big deal. It's when there's dramatic, like marginal 20, 30% changes, and you're like, whoa, the number went from 13 to 20. If that's the case, if the inventory number goes from 13 to 20, you know what that means? Holy cow, people are like really buying Starbucks coffee. They want that coffee. They need that coffee. That means Starbucks is going to report a blowout number. They're going to report a blowout number. Track these numbers on a percentage basis. It'll freak you out. You're like, oh my God, you can see how the sales are going to miss. You won't, the sales are an afterthought. Sales are late. They're a lagging indicator. That's a leading indicator. The issue you'd have to deal with this is, well, how often do they actually update this number? And the answer for you is, I don't know. It depends. It varies. It varies on the vendor. It varies on the trading platform. You might need to go to the company's site, and even on the site, they might not update it every single month. So you might have to track it from quarter to quarter or month to month to see changes in this. But you can see the numbers over here. Look, see how the inventory turnover has been improving? That's a healthy sign. If the inventory is moving off the shelves, it's a good sign. If the inventory is declining, it means it's like walking into a store, it's like walking into Costco or Walmart. You're like, wow, it's stacked with everything I need. That's a bad sign for that store. That store wants half that crap off the shelf. Why? Because if they're missing half the crap, it's going to induce you to buy it before there's nothing left. It actually speeds up psychologically your consumption pattern. The second thing it does, it means it forces the buyer at Walmart to call up the supplier and go, man, we're moving product, get more over here. They run the truck back over. That means their sales are off the charts. The faster they're turning it over, the more money they're making. But I'm going to caution you, this only works for service companies. You talk about Dell, you talk about Tesla, it's useless. Caterpillar, you can forget it because you won't see, those are cyclical businesses that are what's called spotty. They're lumpy. It's like one great quarter, one crap quarter. One great quarter, it's an inconsistency. You need to apply this to companies where the product is consumed literally every single day or on a weekly basis. That's the value of what it does. But it's not a manufacturing business, it's a service business. So let me bring something to your attention, okay? Here's Costco. Costco! Look at what Costco does. Costco's inventory turnover is 13. 13. Now I want you to look at the number, the turnover, year after year after year. What do you notice about it? It never changes. It's marginal changes. Is it a wonder why the stock keeps going up? The stock keeps going up because they're in a, like I call it a prism. It's like you're inside of a box. And as long as you're in that box, you're good to go. You don't want to go outside the box because if you go outside the box, it could imply that Costco's mismanaging its inventory. This shows that management is consistently stocking the shelves and consistently moving product. Sometimes it improves a little, but it never gets that bad. That's the key. The consistency is what drives it. If you track stocks where the number's way up and way down, go look at the chart. What does the chart look like? It goes up and then crashes. Exactly. Because the inventory turnover is the leading indicator of how they're moving product that translates to sales. It doesn't say too much about earnings per se. It relates directly to sales because the margins may change a lot. So you have to kind of look at the margins and see whether the margins are moving. Well, the margins at Costco are pretty much 3%, 2.5% consistently, and the inventory turnover is consistent. So the stock's always consistently going up. That's how they're doing it. And of course, they make money off of membership fees. I mean, there's all kinds of ways they're printing money. But the bottom line, when it comes down to is that the inventory turnover is your leading indicator. I want to compare and contrast to show this to you. Here's Costco. Let's look at Walmart. You don't need me. You can do yourself. Walmart, 9. Walmart doesn't move product as often as Costco. What does a 9 mean? And by the way, it's 9, 8, 9. There was a point at which it was 8.2. That's a big deal. And it had to be restated. But pretty much it averages 9.5 to 9 all the way across. Consistency. But here's the thing. Look at the number. It's 9. What does that mean? It means Costco turns over inventory at a rate of about 30 to 40% per year more. Look at the difference in the stocks if you don't believe me. Look, here's Walmart over the long term, right? Then you look at Walmart and what has it done over the last 2 years, okay? And this is like a freakazoid thing, but if you look at it just over the last year, okay, Walmart's gone from 80 to 100. Okay, it's a 20% gain in Walmart. 20%. Look at Costco. Costco's gone from over here, went to 850 up to about 1,075. So Costco's kind of settling in here. But over time, Costco was what? Was staying ahead of Walmart for a time. Now Costco's starting to slip. It's starting to slip a little bit. Walmart's still holding up. What gives? It could mean that Costco's inventory turnover is slowing down. Remember, this could be stale for Costco. It could be 2 or 3 weeks. You might need to go to the Costco website, go in, pull it out. They might have it published on there. You go to Costco. Where do you go? You go right there. You click on there. You go into the Costco Investor Relations. You go into Costco Financials. You pull out the cost of goods sold, and then you just crunch it yourself over the quote-unquote average inventory. Take the beginning, the ending, add it together, divide by 2. See what they're posting here. This is improved by about 2.5% over the year, and that translates into about a 10% gain in the stock. Track what they do. Look at Target, okay? Target stock looks terrible. Come over here. It's only had a 1% increase over the year. Does that kind of tell you the story? For stocks that are retailers, that are merchandisers, the inventory turnover, okay, needs to be consistent. Here, when it was really jamming at 6.7, 6.1, 6.0. But look at the inventory turnover. Way less than Walmart, way less than Costco. Is it a wonder why this stock's in the toilet? This stock, if they want to get this stock jamming, they're going to have to get that to the Walmart level or perhaps the Costco level. They're going to have to change their model to get it moving, or they're going to be in big trouble. 6% is not going to do it because their competitors are basically moving product faster and in greater size than Walmart is. That's what that's telling you. The Walmart model needs to be changed. If it doesn't, look at the stock. I keep telling you, the inventory turnover, the industry tells you that they should be similar or not that far off. So what you do is you pick the biggest one in the industry as the bellwether and then compare around that individual one. That's how I do it. And Walmart is, steady is okay. But this one, it's got the worst inventory turnover of all of them. Here's another thing to throw out at you. You're thinking that maybe McDonald's is like, oh, 222 is like a big mover. Oh, that's nothing. You haven't seen anything yet. See McDonald's at 222 for their inventory turnover? Let me freak you out. Let's go to Wendy's. Wendy's. So Wendy's is $9. People apparently don't go to Wendy's. Look at Wendy's inventory turnover. It's the same as McDonald's. It's the same as McDonald's. And yet McDonald's stock is holding up and Wendy's stock is not necessarily holding up, right? But look at Wendy's turnover. 258 to 224. See that drop off of 30? Okay, that's a drop off of 10%. That's why the stock's going down. Here's another one. Another big drop off. Again, if the numbers are tracking off a percent or two, nobody cares. Look at the sequential decline in the drop off. Now they're starting to pop. They're starting to move again. But look at the stock itself. See what I keep telling you? A drop off, and I'll bring up like 5 years on this so you can see this. A drop off in inventory turnover is the key to restaurant stocks. I was a hedge fund guy. That was the number we would look at. We just go like, if that number sucks, okay, we're out of the Wendy's business. Okay, it doesn't matter what the margins are to me. If they can't move the product, there's only 2 ways of doing this. If you can't move the product, you got to bring up the margins. And if you can't bring up the margins and can't move the product, I'm out of your stock. I don't even want to be any part of it. It's a red flag. These are asset utilization way of measuring profitability. Let me bring another one to your attention. That was Wendy's. So have any of you ever heard of Burger King, or what they call QSR? QSR, which was the Burger King. Look, QSR, restaurant brands. People are like, what do they do? They own Firehouse Subs, Popeyes, Louisiana Kitchen, Burger King, and Tim Hortons. QSR is massive, people. Go into the Analyze tab, walk it down, and look at the inventory turnover. Okay, it's 36.972. Now, to be fair, McDonald's is McDonald's. This is spread across, a coffee shop, which is Tim Hortons. It's spread across Firehouse Subs, which is kind of like going to Subway or McDonald's. Okay, so it's got a 37. Okay, it's got a 37. But to me, what matters most is it's got to stay between that 35 and that, 40, somewhere in between there. If it varies too much, it becomes problematic. So here's a 2% improvement. That's good. Look down 1%, not a big deal. They can make it up on pricing and margins. They can do that. Look at the big fall off. Now they're starting to recover. Go look at QSR. Take a look at it. Notice here in 2024 where it starts to slip. Why does it start to slip in 2024? Because their inventory turnover is down. They're simply not moving as much product in their different stores. Firehouse Subs, Louisiana Popeyes, they're not selling. They're selling, but that's a 6% drop off. More on a scale at 6 percentage points. But if you equate that to 100%, it's down almost 18%. That's a massive drop off. Go to the chart. Look, see the drop off right here? Pops, it drops. The drop off is what? They're telling you they're not moving product. Then they have the December push and then it settles in. Now it's just sitting in that sideways box. If QSR wants to get its business going up, okay, it's going to have to get that number somewhere back above 37. It says 37. It's going to have to push that back towards 40 or higher. They're going to have to ramp that number back up to get it. The whole idea, restaurants, is marketing. Marketing. Get people in there and get them out the door. Get it off the shelves. That's how they do it, okay? Get that number up to 40. You might see the stock pop 10 or 15%. It's a conservative stock. And I pointed this out in my bullet point here. Like fast food change, sit-down restaurants, it's all this big deal. Specialty designers. So if you're wondering, what do you mean by a specialty designer? I'll give you an example. Look at American Eagle Outfitters. Now, Sydney Sweeney sent this stock skyrocketing. Good for her, okay? Pissed off people. Didn't piss me off. Maybe you want to buy the product. I own American Eagle Outfitter, okay? Inventory turnover is 4.8. What does that mean? It means if the number's 6, it means every 2 months, they're clearing out the shelves at the stores or at the fulfillment houses, wherever they contain the inventory. Every six months are like, we turn it over. Every 2 months, pardon me. This is telling me that every 2.5 months, they just run out of clothing. And they got to come out with a new clothing line, and they got to restock the shelves and start doing fulfillment online or getting them out in the stores. They have to. This is what American Eagle Outfitter does, right? Look at where it was here at 6. Now, again, this is a big drop off. 6 down to 5. Just look at where it was and look at where it is there, okay? This is a small number, which means they're moving it 2 times a year. Like every 2 months, they're clearing inventory and restocking the shelves. That's a 20% drop off. So naturally, what should the stock look like? It should look like a waterfall. See? See how the numbers? So when the numbers, when inventory improves, the hedge funds buy. That's how they do it. And when the inventory is terrible, the hedge funds sell off. This means they're moving product because of Sydney Sweeney. So what you're going to see, because this is a kind of stale number right now, what you're eventually going to see is this is probably going to pop at the end of 2025. My guess is that's going to be 6 to 6.5. Somewhere between there, that will take precedent and pop that. That is my best guess on this. Okay? I can't emphasize this enough. A lot of you live and die by charts. I love charts. Don't get me wrong. They're the ultimate timing mechanism to figure out how to position. I use charts as entry and exit, risk management, and volatility mapping. But they never tell me why to buy something. If you want to know why to buy something, dig into the numbers. You don't need to be a rocket scientist. Just they're provided for you on many platforms. This platform provides it. It makes it easier for you to understand. But don't apply the logic around inventory turnover to Caterpillar or Deere or ExxonMobil. You're wasting your time. Their inventory is complete. It's a different industry, a different business model. You cannot cross those roads. It makes no sense. It's a big deal for service industries. Here's another one for you. Like, I want to know what's going on with a stock like Kohl's. How is Kohl's doing? Now, Kohl's had a really kick-ass quarter. I don't know if it's gonna populate here. Is it gonna populate? I don't see it coming up. Is Kohl's like a foreign company or something? I guess it's not. There's nothing here on the Analyze tab for Kohl's. Let me pick out another designer. Let's go to Guess. How about Guess? Okay, here's Guess. Go to the inventory turnover. Let's see what Guess does. They're not providing. Oh my God, Guess is not. They don't provide it for you. They don't. Maybe because Guess is an ADR. I'm not sure. Some companies provide, some companies don't. You can go to any specialty retailer that you want and you could figure it out. How about something like Lululemon? Stock's been annihilated, right? Come down here, go to the Analyze tab. Let's see what the inventory turnover is starting to tell us. See if they're actually moving product. Okay. Inventory turnover is 3, 3, 2, 3. Okay. What's the current one? 2.83. So at the end of 2024, it's 3.12. Now it's 2.83. Now you're looking at that going, yeah, but that's only off 0.2. Yeah, it was enough to drop the stock 300 points. They're not selling the product as well as they used to. I know it says it's a 7%, 0.3% year over year, but that's from 2023 to 2024. We're in 2025, and that's the current one. So even a small drop-off can take that business and undermine it and wreck it. These are how I used to read things and think to myself. And I just wouldn't rely upon one number. There would have to be like a confluence of, chronological layout of numbers, year by year, quarter by quarter. I'm looking for something extraordinary. I'm looking for an improvement, or I'm looking for, fatigue. And if there's fatigue, I would just automatically know I've got to cut back on the stock. The chart would be way too late in the game. That's the value I brought to you here. And I just wanted you to understand that. So this program, okay, was a 4-day program, financial radioactivity, the value of asset utilization metrics. Again, there's 4 up here: total asset, fixed asset, receivables, inventory. Fixed asset works for cyclical companies: Caterpillar, Deere, Tesla, Ford, GM, furniture companies, return on equity, inventory, receivables. Those work mainly for retail and service companies. So they're different. That's what the inventory turnover ratio is for. I hope this has been a level of value to you. I am now going to shift back towards other, programming, topics and whatnot, back to my usual self. But it was just 4 days of fundamentals apart from last week's risk impact week. In the meantime, I'm going to turn this over to Mr. Chapman. I have to eat some food, get on a bus, and teach Loyola today. I'm teaching time value of money today, which is interesting stuff. Hey, Brandon, how are you?
Good. How are we doing?
Oh, I'm having a bad day on the long side, but man, Brandon, I keep telling you, I don't know what it is, but my shorts are they just keep working. I got to stick with the shorts and avoid the longs, I guess.
It is hard to kind of nail down, okay, what is going to move? Now, you're talking time value money today, so people thinking the PPI print may lead to the Fed cutting rates, maybe even 51%, who knows? If interest rates drop, what does that do to the future value of a stock, bringing it back to the present?
I'm not sure, Brandon, but the one thing I can see, just the eye test, it's the same playbook. Every time I wake up, it's, I'm going to buy a 52-week high at an outrageous valuation that makes no sense, and I'm going to sell a low PE multiple. I'm going to rotate out of defensive. I'm going to rotate in aggressive. Personally, Brandon, this is just me. I think this is going to continue on to the end of the quarter. I think that's just the way it's going to go, because it's all about window dressing at this point. So it's a race to put up numbers.
The thing that I hate is the fact that those rotations last like 2 days, and then we're back. It's like we go up 2 and then back 2, up 2, and we're going nowhere, right? We're stuck in neutral. Granted, the market's breaking out here because you have a handful of stocks that are kind of leading the way for the most part, but But I just like, man, if we're going to go up, let's go up a couple more days. If we're going to go down, let's go down a couple more days. And I'll be perfectly content with what's going on.
I got a question for you, Brandon. I defy you or Kaufman or any of you to tell me the last time the market was down back to back. When was the last time the S&P was down back to back 1%?